Banks serve a purpose, but they may not always have your best interests at heart. A lesson a 44-year-old editorial content manager learned the difficult way. The Wall Street Journal shared the story of David Fucillo, who diligently built his emergency fund by depositing money into a Capital One financial savings account drawn by its initial high interest rates. However, by last fall, he noticed his earnings had significantly decreased even as overall interest rates were on the rise. Hello, I'm Ivory Hecker for Noble Gold News. Fusillo found that his considerable savings were yielding a mere 0.3% interest rate, a situation that potentially cost him over $1,000 in yearly earnings. His story is far from unique, with the Federal Reserve increasing interest rates starting in 2022. Many Capital One customers anticipated their savings rates would climb as well. Instead, they found themselves earning significantly less than the 4.35% interest rate touted for Capital One's top-tier savings accounts. This issue stems from a strategic choice by Capital One. In 2019, the bank introduced the 360 Performance Savings Account, but kept existing customers in the older 360 savings accounts. These older accounts, once competitive in their interest offerings, were phased out for new customers. Following the Federal Reserve's interest rate increases, only the newer 360 Performance Savings accounts received boosted interest rates. A Wall Street Journal investigation revealed 24 complaints to the Consumer Financial Protection Bureau found that many customers shared Fusillo's grievances. They reported not being informed of the newer, more lucrative accounts and said the bank denied requests for retroactive interest. The pitfalls of saving with banks. Well, it's wise to keep some cash in savings, especially with banks now advertising 4% interest rates. There's always a risk of not getting the best deal, as Fusillo's experience demonstrates. It's all fun and games until the Internal Revenue Service comes after you. Last year, Americans rushed to move their money to banks after being offered 4% interest rates. This year, Uncle Sam is asking for his cut, a huge one. As the April 15th tax deadline approaches, many are discovering that the interest income earned from these accounts has increased their income tax obligations. This could potentially decrease their tax refunds or, in some cases, place them in a higher tax bracket. Although taxpayers are conscious of the earnings from these accounts, the full impact is often not felt until they review their consolidated 1099 brokerage statements or receive their 1099 INT tax forms from banks and other financial institutions, revealing the substantial interest earned. According to the latest projections from the Congressional Budget Office, taxpayers are expected to report $282 billion in taxable interest and dividend income for the 2023 tax year, an increase from $237 billion in 2019, the most recent year for which annual totals are available. Interest rates on savings accounts were historically low for many years. However, following the Federal Reserve's decision to increase the benchmark federal funds rate in 2022, numerous financial institutions raised the interest rates offered on cash and similar investments. This allowed savers to earn a respectable return while maintaining liquidity. The average interest rate for high-yield savings accounts was 4.33% in 2023, a significant rise from the 1.09% in 2022 and just 0.38% in 2021 per bank rate data. The more you earn from your savings account interest, the bigger the share the IRS will take. For certificates of deposit, any interest earned is subject to annual taxation regardless of the CD's maturity date. However, interest earned on CDs or other investments within a tax-deferred retirement account like an IRA will not be taxed until the funds are withdrawn. Time for a reality check. This is why we've seen an avalanche of gold IRA account applications since January. Savers are finally waking up to the fact that simply putting your money in the bank is just as good as throwing it away. Not only do they need to give most of it back to the government, but the money they have left will be devalued. With a traditional gold IRA, you enjoy a tax break when you make your deposit. You can use whatever tax refund you get to reinvest in another asset or even a new business. With the Roth Gold IRA, you pay the taxes up front, but not on your capital gains when you liquidate. So it's your choice. Do you want to pay half of what you earn from savings accounts interest rates and devalue the rest of your money, or invest in an asset that will not only appreciate in value but also give you a tax break? This is why it is still best to invest in assets like gold and with companies like Noble Gold Investments. First, even with gold breaking its all-time high, gold is still highly underpriced, which means the possibility for growth is massive. More importantly, the economic and geopolitical instability will further devalue the dollar and put our economy in distress. Second, you would need a hedge, and nothing has beaten gold in that category. Its inverse relationship with the market and cash will give you the peace of mind that you will have the asset that can carry you and your family while you wait for other assets to recover. Third, Noble Gold Investments is a US-based gold company known for transparency. CEO Colin Plume actually decided to put up a gold company after working for another gold company. Wanting to provide better service, Colin makes sure that Noble Gold Investments will be honest and transparent with their clients. You can start by downloading Noble Gold Investments guide at noblegoldinvestments.com or call them 877-646-5347.